What is the presidential election cycle theory? The presidential election cycle theory, developed by Yale Hirsch, the founder of Stock Traders Almanac, suggests that the stock market follows a predictable pattern after each U.S. presidential election. According to this theory, the stock market tends to underperform in the first year, following the election, followed by a recovery and peak in the third year, and then decline in the fourth year of a presidential term. The cycle repeats itself with each new presidential election. The presidential election cycle is based on the belief that a change in the presidential priorities significantly influences the stock market. According to this theory, the stock market tends to perform the strongest during the second half of a presidential term when the incumbent president focuses on stimulating the economy to enhance their chances of re-election. Data from the past few decades appear to support the notion of a stock market surge in the later half of an election cycle, although the limited number of election cycles make it challenging to draw a definite conclusion. So what is this? First of all, you have to understand that using a presidential election cycle, we use it with other indicators, sort of a weight of evidence. And when we're looking at this presidential election cycle, we like to put other indicators combined to get the best entry price and also to get the best exit price. But let's go over this a little bit. So if we break it down into every 4 years in a pattern, any president, specifically the Democratic, not that it makes a difference Republicans or Democratic to this system, but the year after the election, usually the stock market has lower effects. And then the second year, even lower numbers. The third year, it jumps up, going into the fourth year when the new president or the incumbent-elect is elected. What's the reasoning behind this? Think of it like this. A new president has made a lot of promises. These promises need to be paid. These promises need to be done inside. He's not worried about the stock market going up. He's more worried about the stock market going up in year 3 and 4, where voters will remember this time. So he positions himself for the first year after the election not to do that well, and definitely not the second year to do very poorly, but people will remember the third year and going into the fourth year. Let's go further. The presidential election cycle, introduced by stock market researcher Yale Hirsch in his Stock Traders Almanac, had significant impact on market timing strategies. Hirsch's almanac, first published in 1967, popularized several influential theories such as Santa Claus rally in December and the best 6-month hypothesis, which suggests the stock prices tend to dip during the summer months and fall months. Among Hirsch's beliefs is the notion that the 4-year presidential cycle serves as a crucial indicator of the stock market performance. Drawing on historical data spanning several decades, Hirsch argued that the initial years of presidential term typically coincided with weaker stock market performance. Let's bring it down over here and you can study this chart. According to Hirsch's theory, among assuming the presidency, the chief executive tends to prioritize their core beliefs, proposals, and cater to the interests of their key supporters. However, as the next election approaches, the theory suggests that the presidents shift their focus toward the strengthening of the economy to improve their chances of re-election. Consequently, the major stock market indexes are more likely to experience gains during this period. Notably, Hirsch's theory implies that these patterns hold true regardless of the president's political affiliation. It is important to recognize that while presidential election cycle theory has gained popularity, is not infallible, nor universally accepted as reliable predictor indicator of stock movements. Numerous factors include economic conditions, corporate performance, geological events, and investor sentiment contribute to market dynamics. Therefore, it is prudent for the investors to consider the presidential election cycle theory as only one aspect of many formulating an investment strategies. A weight of evidence needs. All our indicators, we use a weight of evidence. You will see usually one indicator does not make a strategy and should be coupled with other indicators and philosophies. But definitely using over a 4-year cycle, the presidential election cycle theory, it can give you an investing edge. As you see from this chart, the ups and downs in the 13.5 and the 7.5%, and going from there. Let's continue even further. While it's important to acknowledge the numerous factors can influence stock performances, data from the past several decades suggests a potential correlation between the presidential election cycle and the stock market returns. A study conducted by Charles Schwab researcher Lee Bahl examined market data from 1933 to 2015, revealing a tendency for stronger market gains in the third year of presidency. The analysis of the S&P 500, a broad stock market indices since 1933, indicates the following returns in each of the presidential cycles: 6.7% year after election. Second year, 3.3%. Third year, 13.5%. Fourth year, 7.5%. And that is just using beginning of the year to end of the year, not even trying to look at certain cycles of ups and downs and which stock is doing well. This is just using from beginning to end. Moreover, since the 1930, the average annual return of the S&P 500 adjusted for inflation stands at 6.34%. These figures lead support the idea of the third-year bump in the stock market performance as predicted by the presidential election cycle theory. While the average return provides insights, the theory's reliability across different election cycles is also crucial. Between 1933 and 2019, the stock market saw gains in 70% of the calendar years. However, during the third year of the presidential election cycle, the S&P experiences an annual increase of 82% of the time, demonstrating a notable consistency. In comparison, both the first and second years of presidency yielded market gains of 59% of the time. It's worth noting that although these findings highlight a potential correlation, they do not establish causation or account for these intricacies of the stock markets. Investors should consider various other factors and employ comprehensive research when making investment decisions, as a market condition and trends can be influenced by multiple of economic, geopolitical, and global factors beyond the presidential election cycle. The presidential election cycle theory, while providing some insights, has limitations, but it is an excellent way to give your system a start. Imagine your system starts with the presidential election, knowing that you want to short the market the year after election and the second year and go long into the third year, into the fourth year. This is powerful indicators that can be used. Let's continue further. Since 1928, the third year of the presidential cycle has produced positive S&P returns 78% of the time, generating 13.5% average return versus an all-year average of 7.7%. We did not find other consistent indicators in the monetary and fiscal policy signals, rising versus falling rate environments, for example, that might also offer insight on 2023. But we do believe a party's degree of government control may be a critical factor. We're going to break it down into the next level of the president election by looking at who has a Republican sweep, who has a split Congress, and a Democratic sweep. A single party held the trifecta of the presidency in the House and Senate majorities 2/3 of the time in this first and second years of the cycle, as Democrats did in 2021 and 2022, but only 1/3 of the time in the third and fourth years. This is a familiar phenomenon in U.S. politics. The president's party often faces setbacks in the midterm elections, but implies that the relevant election cycle may be congressional rather than presidential. Markets may be simply rewarding gridlock. Third years that follow a switch from unified to split governments average 15% returns compared to 10.7% for the third years in which the trifecta was preserved. The gridlock questions also seems important given the likely contrast between the 2022's ambitious legislative agenda and the anxiety and potential deadlock in 2023. The sequence also may be important in anticipating how presidential cycle theory will be played out in 2023. With their glass half full outlook, commentators tend to focus on above average returns in the third year. It's looking the same way this year in 2023. We will see what happens, but it's looking to be a very good year. This will help us in deciding in our system that we are one of the factors are very bullish for the year 2023. So what do we think of the presidential election cycle theory? We love it. Follow it each of the years, see if it works for you, put it in your system, and remember, study it, analyze it, adapt it. Peace.